There is a word that has made more money for Wall Street than any stock, any trade, or any algorithm ever built. It's not buy, it's not sell. The word is access. Every decade or so, the financial industry announces that regular people are finally being let in, that the gates are opening, that the playing field is being leveled. And every single time, the people who are already inside the gates end up richer than before. Not because the access was fake, the access was real. The trap was in the timing. Right now, the biggest version of this trick in history is being loaded into your retirement account. It involves $12 trillion, 85 million workers, and a policy change so boring that almost nobody noticed it happen. By the time most people figure out what changed, the people profiting from it will already be done setting up. This is not a story about one company or one IPO. This is the story of a pattern that is repeated 5 times in 30 years, and you are living through the 6th. Let me introduce you to 2 people. Maya is a 34-year-old middle school science teacher in Ohio. 8 years ago, on her first day at the district, HR handed her a packet. Somewhere around page 11, she checked a box that said Enrolling Retirement Plan, picked the option that had a year in its name, Target 2055, and never thought about it again. She doesn't know what's in that fund. She doesn't know what it costs. She doesn't even know what target date means. What she knows is that every 2 weeks, money leaves her paycheck and goes somewhere responsible. That's enough for Maya. Raj is 31. He's a software engineer in Austin. He has 3 brokerage accounts, a spreadsheet that tracks his net worth to the penny, and opinions about the Federal Reserve that he will share with you whether or not you ask. On June 12, 2026, Raj woke up at 5 a.m. Central Time to buy shares of the most hyped IPO in human history, SpaceX, ticker SPAC, $135 a share. He bought 12 shares and posted a screenshot to his group chat before the market had been open for 30 seconds. Maya found out SpaceX went public 3 days later when a student mentioned it during class. Now here's what makes this interesting. Both of them think they understand what happened. Raj thinks he made a smart, early bet on the future. Maya thinks it has nothing to do with her. They're both wrong. Because here's the thing about Maya's retirement account. That target date fund she picked 8 years ago and forgot about, it owns thousands of companies. It rebalances automatically. It charges her almost nothing, a few dollars a year per 10,000 invested. It is, by nearly every measure, one of the most elegant financial tools ever built for a regular person. And somebody is about to change what's inside it. Not Maya. Nobody is going to ask Maya. The change will arrive the same way everything in Maya's financial life arrives. Quietly, in a default, while she's teaching 6th graders about photosynthesis. And by the time she notices, if she ever notices, it will already be costing her money. But to understand why this particular change matters, you have to understand the pattern. Because this is not the first time Wall Street opened the gates and called it a gift. It is the 5th. The first time was mutual funds. In the early 1990s, most Americans had never owned a stock. The idea of regular people investing felt exotic, almost reckless. And then the mutual fund industry launched one of the most successful marketing campaigns in financial history. The pitch was simple. You don't need to pick stocks. Let a professional do it for you. Just hand us your money and we'll handle everything. Millions of people signed up. Money poured in. By the late 90s, mutual funds held trillions. Regular people were finally in the market. And the fund companies? They were charging 1% to 2% a year on trillions. Do that math. That's tens of billions of dollars annually in management fees, extracted from regular people who were told they were finally being included. The access was real. The fees were the product. The second time was online trading. In the late 90s and early 2000s, companies like E-Trade and Ameritrade told regular people they could trade like professionals. No more calling a broker. No more paying $50 commissions. The barriers were gone. You had access. Millions of regular people started day trading. The vast majority of them lost money. Study after study showed that the more actively individual investors traded, the worse they performed. One famous paper by researchers Brad Barber and Terence O'Dean found that the most active traders underperformed by over 6 percentage points a year. But the brokerages made money on every single trade. The more you traded, the more they earned. The access was real. Your activity was the product. The third time was zero commission trading. Around 2019, Robinhood and its competitors eliminated trading commissions entirely. Free, no cost to you. Sounds like the most democratic thing ever, right? Except the way they made money was by selling your orders to high-frequency trading firms through a system called payment for order flow. Those firms would execute your trades and skim fractions of a penny on each one. You were getting access to free trading. You were also, in a very real sense, the thing being sold. The access was real. You were the product. The fourth time was cryptocurrency. Regular people were told they were finally getting access to the financial revolution. Decentralized, democratized, no banks, no middlemen. Except there were middlemen. The exchanges charged spreads and fees. The early insiders held massive positions they could sell into retail demand. By the time regular people flooded in during the peaks of 2021, the early holders were cashing out. One study estimated that during the crypto boom, the majority of retail investors who bought during the hype cycle lost money, while early insiders and exchange operators captured enormous profits. The access was real, the exit liquidity was you. The fifth time was SPACs, special purpose acquisition companies. In 2020 and 2021, Wall Street told retail investors they could finally invest like insiders, get in on deals before they go public, democratize deal making. What actually happened? SPAC sponsors got 20% of the company essentially for free, a structure called the promote. Retail investors bought shares at $10, the deals closed, and within 2 years, the average SPAC had lost more than half its value. One study from Stanford found that the median SPAC destroyed roughly a third of its value within a year of merging. The sponsors made hundreds of millions. Regular people held the bag. The access was real, the structure was the trap. 5 times in 30 years, the same script, different costume. Step 1, build something valuable behind a wall regular people can't climb. Step 2, wait until the easy gains have been captured by the people inside the wall. Step 3, knock down the wall and call it democratization. Step 4, charge fees on the flood of new money coming through the gate. Every single time the word was access. Every single time the timing was late. And every single time the people selling the access made more money than the people buying it. Now let me show you number 6, because number 6 is different. Number 6 doesn't need you to open an app. It doesn't need you to click buy. It doesn't even need you to know it's happening. Number 6 comes through the default. To understand what's about to happen, you need to understand the most powerful force in retirement investing. It's not compound interest. It's not the stock market. It's the default option. When you start a new job and enroll in a 401k, most people never customize anything. Research from Vanguard shows that the overwhelming majority of participants simply accept whatever option the plan puts them in automatically, the default. For most Americans, that default is a target date fund. It's the one with a year in its name. Target 2040, Target 2055. You pick the year closest to when you plan to retire, and the fund handles everything else. It owns stocks when you're young, shifts toward bonds as you age, and charges you almost nothing. 3 to 0.08% a year. These funds are everywhere. They hold trillions of dollars. Not because millions of people independently decided they were the best option, because millions of people like Maya checked a box on their first day of work and never looked at it again. The default is the most powerful financial decision most people will ever make, and most people don't even realize they made it. Now here's where the machine gets interesting. Because whoever controls what goes inside that default fund controls where trillions of dollars flow. Right now, the inside of Maya's target date fund is beautifully simple. Broad stock index funds, bond funds, maybe some international exposure, all of it cheap, liquid, and transparent. She can see exactly what she owns. She can sell any of it instantly, and the total cost is negligible. That simplicity is not an accident. There's a law called ERISA, the Employee Retirement Income Security Act, that governs retirement plans. It requires the people running your 401k to act as fiduciaries. They're legally obligated to put your interests first, to be prudent, to not fill your retirement with expensive, speculative, hard-to-sell investments. For decades, that fiduciary duty, plus the fear of getting sued, kept the expensive stuff out. The guardrail worked. In August of 2025, an executive order was signed. Its title was perfectly engineered to sound harmless: democratizing access to alternative assets for 401k investors. There's that word again, democratizing. What this order actually does is direct the Department of Labor and the SEC to loosen the rules governing what's allowed inside your retirement account. Specifically, it opens a door for private equity, private credit, venture capital, and other alternative assets to be included in 401k plans and, critically, in the default target date funds where most of the money already sits. The scale is staggering. The 401k system holds more than $12 trillion. It covers roughly 85 million American workers. Let me make that real. If you have a workplace retirement account, a 401k, a 403b, any employer-sponsored plan, you are one of those 85 million. The money they're talking about rearranging includes yours. Now remember Maya. She doesn't pick her investments. She doesn't read plan updates. She checked a box 8 years ago and walked away. If private equity gets added to her default target date fund, Maya owns it automatically. She didn't choose it. Nobody asked her. It arrived in the default, silently, the same way everything in her financial life arrives. Except this time, the quiet arrival is not working in her favor. Because what's being added is fundamentally different from what's already there. To understand why this is happening, you only need to understand one number, the difference between 0.03% and 1.5%. Maya's current index fund charges about 0.03% per year. That's 3 basis points. On $50,000, that's $15 a year, barely the cost of a meal. The private equity funds being proposed for 401k plans are expected to charge between 1 and 1.5% per year. Some use the classic 2 and 20 structure, 2% of your money annually, win or lose, plus 20% of any profits. Let me show you what that difference actually costs over a career, because percentages are designed to feel small. That's the trick. Take $100,000, grow it at 7% a year for 30 years. With a near zero fee index fund, you end up with roughly $760,000. Same $100,000, same 7% gross return. But with a 2% annual fee, you end up with about $430,000. The fee didn't take 2%. The fee took $330,000, more than 40% of your retirement. Gone, transferred, not lost to bad markets or bad luck, transferred from your retirement to someone else's revenue line. The Department of Labor's own published guidance warns that just a 1% difference in fees can reduce your final retirement balance by roughly 28% over a career. 1%. And these funds want to charge more than 1%. Now multiply that across the system. $12 trillion in 401k assets. If even a fraction of that shifts from 3 basis point index funds to 1.5% private funds, you're talking about tens of billions of dollars per year in new fee revenue for the asset management industry. That is the incentive. That is why the biggest money managers on the planet are pushing this so aggressively. BlackRock, Apollo, Blackstone, Empower, they've all formed partnerships. They've all built products. They've all lined up behind the word democratization. BlackRock's CEO has publicly pitched a future where the standard portfolio shifts from 60% stocks and 40% bonds to 50/30/20, with that last 20% in private assets. Empower's CEO compared this moment to when 401ks first gave regular people access to stocks. And those are powerful, sincere comparisons. The enthusiasm is real. So is the math behind the enthusiasm. Let me be fair, because there's a real argument on the other side, and I want to give it its full weight. The case for private assets and 401ks goes like this. For decades, the best performing investments in the economy, venture capital, growth equity, private infrastructure, have been locked behind a wall. Only wealthy, accredited investors could participate. By the time these companies went public and regular people could buy in, the explosive early growth had already been captured by insiders. BlackRock published research claiming that adding private assets to a retirement portfolio could boost annual returns by roughly 0.5 percentage point, which compounded over 40 years could mean approximately 15% more money at retirement. 15% more. That's a real number. That would change lives. But here's the question nobody promoting this change wants you to ask. Does the extra return survive after you subtract the extra fees? Because if a private fund delivers 0.5% more in gross returns, but charges 1.5% more in fees, you didn't get better access. You got a worse deal with a better story. Now let me show you the part that connects everything. Because this is where the SpaceX IPO stops being a headline and starts being evidence. SpaceX went public on June 12, 2026 at $135 a share. It was the largest IPO in history. The company was valued at approximately $1.77 trillion. But SpaceX had been a private company for over 20 years before that moment. And during those 20 years, the company grew from a startup that could barely get a rocket off the ground to the most valuable aerospace company on Earth. Here's a number that tells you everything. A venture firm called Founders Fund invested roughly $20 million in SpaceX in 2008. By the time of the IPO, that stake was reportedly worth more than $50 billion. That is a return of approximately 2,500 times their money. Every single dollar of that 2,500 times return was captured while SpaceX was private, while regular people were legally not allowed to invest. By the time the IPO opened the doors to the public, one analyst estimated the company was trading at roughly 94 times its annual revenue. Another research firm pegged the company's fair value at closer to half the IPO price. The early investors got in at the bottom and are exiting near the top. The public got in at the top and is calling it access. This is not unique to SpaceX. This is the structural pattern. In the mid-1990s, there were roughly 8,000 publicly traded companies in the United States. Today, there are about 4,000. The number got cut in half. Not because America stopped building companies, we're building more than ever, but they're staying private. In 1999, the median company went public at around 5 years old. By 2025, that had stretched to about 12 years. Companies wait twice as long, get many times bigger, and capture all their high growth years privately, behind the wall. By the time these companies go public, or get stuffed into a 401k through a private equity fund, the explosive growth phase is largely over. What's left is the mature phase, the expensive phase. The phase where returns slow down and fees eat them alive. So let me state this as plainly as I can, because it's the most important idea in this entire video. The system spent 30 years moving all the best growth behind a wall that regular people couldn't climb. And now that the growth on the other side of that wall has mostly already happened, they're knocking down the wall and calling it a gift. They're not giving you access to the upside. They're giving you access to what's left over after the people inside already took theirs. You're not the early investor. You're the exit. Now pull back and see the full picture, because the retirement account change isn't happening in isolation. It's the latest chapter in a 30-year restructuring of who gets the best financial opportunities and when. Phase 1 was shrinking public markets. Fewer IPOs, more companies staying private, more growth happening behind the wall. That concentrated the best returns in the hands of institutional and wealthy investors. Phase 2 was building demand. Every headline about a venture-backed company going from nothing to $1 trillion valuation reminded regular people that they were missing out. The fear of being left behind built slowly, over years. Phase 3 is happening now. Open the gates. Invite $12 trillion of retirement money into private assets. Charge premium fees on the flood of new capital. And do it through the default, so you don't even need people to say yes. It's not a conspiracy. Nobody sat in a room and planned these 3 phases on a whiteboard. It's something more effective than a conspiracy. It's incentives. Every player in the system is rationally pursuing their own interest. The venture firms want liquidity. The asset managers want fee revenue. The policymakers want to look like they're helping regular people. And none of them need to coordinate because the incentives all point in the same direction. The people who should be sounding the alarm are, in fact, sounding it. Senators from both parties have raised concerns. The SEC's Investor Advocate Office has said they're studying the issue. Consumer advocates have pointed out that the fee differential alone could cost workers hundreds of billions over a generation. But alarms are quiet things when the money is loud. And here's the part that should genuinely concern you. Every previous version of this pattern, the mutual fund fees, the day trading losses, the crypto crashes, the SPAC collapses, those required you to actively participate. You had to open an account, click a button, make a choice. This one doesn't. This one arrives in the default, the one thing most people never change. The one thing designed to work without your attention. For the first time in the history of this pattern, the access trap doesn't need your permission. It just needs your inaction. And inaction is the one thing 85 million retirement savers have been providing reliably for decades. So what do you actually do? Because I don't want to hand you anxiety without handing you something useful. The entire system we've described works best on people who aren't paying attention. So the first thing you do is pay attention. Log into your retirement account. I know, nobody wants to. Do it anyway. Find out what you own and what it costs. Look for the expense ratio. If you're in a low-cost index fund or target date fund paying
under about 0.2%, you are in excellent shape. Your job now is to protect that. If you see new options appearing in your plan, words like alternative, private, enhanced, real assets, that is your signal to read every word before you touch anything. And if those options start showing up inside your default fund without your input, that's your signal to make some noise with your HR department. Second, when someone offers you access to something exciting, translate that word immediately into 3 questions. What does it cost? Can I sell it when I need to? And am I getting the early growth or the leftovers? Run every shiny new investment through those 3 filters, every time, for the rest of your life. Third, separate the company from the price. SpaceX is a phenomenal company. At 94 times revenue, it might simultaneously be a terrible investment. Those are 2 different questions, and the entire system is built to get you to answer only the first one. Always ask the second. And fourth, respect what boring already gives you. The low-cost index fund, the thing quietly compounding in the background while you ignore it, is one of the most powerful wealth-building tools ever made available to a regular person. It is the one place in finance where the system actually works in your favor, where the fees are negligible, the diversification is automatic, and the long-term results beat the vast majority of professionals who charge 50 times more to do worse. The entire democratization pitch is a campaign to convince you that boring isn't good enough, that you deserve access to the exciting stuff. But for most people, over most of history, the exciting stuff is where wealth goes to die. Boring is not a consolation prize. Boring is the edge. Let me bring this back to Maya and Raj, because I owe you the ending. Raj bought 12 shares of SpaceX at $135. He might do fine. SpaceX might grow into its valuation over the next decade. That genuinely could happen. But what Raj actually did was buy a single company at 94 times revenue at the exact moment the earliest investors were cashing out a 2,500 times return. He bought at the top of the value curve and called it getting in early. Maya didn't buy SpaceX. Maya doesn't know what SpaceX's ticker is. Maya owns the whole market automatically for almost nothing. And when SpaceX eventually joins her index, if it does, she'll own a small slice of it at whatever price the rules say, as one piece of thousands. Maya's strategy isn't exciting. It isn't bold. It won't make a good screenshot for a group chat. But over 30 years, it will almost certainly beat Raj, not because Maya is smarter, because Maya's system doesn't need her to be smart. It just needs her to not get in its way. The danger is that someone is about to get in its way for her. And by the time she notices, the fee meter will already be running. The people who build wealth over a lifetime are rarely the ones who found the best investments. They're the ones who understood the rules before everyone else. And the most important rule in finance has never changed. When someone tells you the gates are finally opening for regular people, the first question isn't what's inside. The first question is why now? The answer to that question has never once been because they were thinking of you. And one last thing, in case it needs saying, I'm not a financial advisor, and none of this is financial advice. It's just pattern recognition for educational purposes. What you do with your own money is your call. Make it count. If you want to understand more about how this system actually works, subscribe. I'll keep doing the reading so you don't have to.